On the surface, everything looks to be running smoothly in the US economy. The stock market continues to break new all-time highs, GDP growth remains healthy, and the job market still looks relatively strong. However, if we dig deeper, we can see that there are a number of very reliable indicators that are flashing red and predicting that things are about to change very soon, in a matter of months to be precise. And it seems that a number of large global financial institutions, as well as prominent names in the investing world, are starting to notice what these indicators are pointing towards and have begun to ring the alarm bells on what could soon be the end of an era. Now, the CEO of the largest global bank, JP Morgan, Jamie Dimon, has been pretty outspoken in 2024 about the risks of a hard landing and what he believes to be the worst outcome of stagflation. When asked about the prospect of a hard landing a few months ago, Dimon did say, "Could we actually see one? Of course. How could anyone who reads history say there's no chance?" Now, a hard landing refers to when a government fails to avoid severe economic slowdown following a period of rapid growth and it triggers a recession. The more dependent the economy has become on fiscal stimulus or easy money, the more difficult it does become to wean off of expansionary policy, and the more vulnerable the economy becomes to a hard landing due to even minor checks on expansionary policy. We've certainly seen this easy money go away in recent years, with interest rates surging to highs not seen since the global financial crisis, after being close to zero for the best part of the previous decade, meaning that money is much more expensive to borrow. And we can see by looking at the M2 money supply, the amount of new money being pumped into the system has slowed right down over the last few years too. The M2 money supply was massively pumped during the pandemic years, growing from around $15 trillion to $22 trillion between 2020 and 2022, a staggering 46.7% increase in just 2 and a bit years, clearly having an influence on the surging price of assets as well. But since this peak in the M2 money supply in April of 2022, we've actually seen a complete stagnation in this growth, and M2 is actually down slightly from this point today at approximately $21.4 trillion. Now that the brakes have been slammed on this liquidity increase across the economy, it's going to start to have an impact on economic growth and asset prices, but things may take many years to flow through and have an impact. And if we are to avoid a hard landing, and therefore a recession, we are going to have to hope that this time is different when it comes to what the yield curve is projecting to happen in the near future. The yield curve is the relationship between the interest rate on short and long-term maturity bonds, often the 2-year versus the 10-year durations, in which typically a longer-term duration bond will offer a higher yield compared to the shorter-term maturity. However, when the yield curve inverts, meaning that short-term interest rates are higher than long-term rates, this has typically been a slam dunk indicator that a recession is coming. Now, the inverted yield curve is so reliable at forecasting future recessions that it is widely used across the financial world to project what is going to happen to the economy in the future. Looking back across history, we can see that the yield curve has only inverted a handful of times, but each and every time that this has happened, it has led to a recession soon after, represented here by periods shaded in grey. Now, this includes all of the big ones like the global financial crisis in the late 2000s, and also the dot-com bubble, as well as the recessions in the 1990s and the 1980s. However, the key thing to note here is that the recession doesn't typically kick in until shortly after the yield curve uninverts. Now, fast forward to today, and the situation we have here is that the yield curve has recently just uninverted after a period of approximately 2 years being inverted, and if the history of this tried and tested indicator tells us anything, unless this time is different, we will shortly be seeing a recession hit the economy. For the time being, however, the stock market is doing really well and continues to break new all-time highs pretty much every week. For those looking to make the most of the current market or to get prepared for any potential market corrections we see in the future, Moomoo is a great trading and investing platform to give a try, and they are kindly sponsoring today's video. Moomoo's platform has a vast technical analysis toolkit of over 100 indicators, 45 drawing lines and 6 chart types for a more informed trading experience. They have a 24/7 news function that integrates more than 50 professional and quality news sources to give you the latest investment news and global market information, giving you the key information needed to make quick and informed decisions. Moomoo also offers 6 types of conditional orders, including stop loss and take profit, enabling you to capture potential profits and manage risks more effectively without the need to constantly monitor the market. Furthermore, Moomoo supports pre- and post-market trading, fractional share trading, and is also one of the lowest cost trading platforms with zero commission on stocks, options and ETFs, with no minimum deposit requirement and no account maintenance fees. Now is a great time to join Moomoo, as there are a number of great incentives they are offering right now. If you are a new user, sign up using my link in the description and make a qualified deposit to receive up to 15 free stocks, along with a boosted rate of 8.1% APY for 3 months up to $20,000 on idle cash. So sign up to Moomoo today by using my link in the description or in the pinned comment. Now, earlier in the year, Jamie Dimon did also mention stagflation being the worst possible outcome for the US economy, a scenario where inflation continues to rise, rates stay high, growth slows and unemployment rises. This is also something that another giant global bank, Morgan Stanley, just warned about the other week, with Aaron Dunn, their co-head of value equity, appearing on CNBC to discuss it. Now, Aaron believes that inflation will be structurally sticky for longer due to a generational shift where we've got an aging workforce and a lower number of new people coming into the workforce. This will lead to a lull in the labour force pool, which he believes will drive up wage inflation over time. Now, just the other week, we saw US inflation rise to 2.7% for November, up from 2.6% in October, and marks a continuation of the rise that we have seen since September's low as we move further and further away from the Fed's 2% target. And on a month-on-month basis, this is an increase of 0.3%, which is the hottest monthly rise that we have seen since April. What's worse is that inflation is even higher in a number of basic necessities like car insurance and repairs, transportation and homeowner and rent costs, meaning that those who are on lower income brackets will be getting hit particularly hard. We are now firmly treading the same path as in the 1970s when we saw CPI surge in an initial wave, then drop back down to more normal levels before surging once again in a second inflationary wave to even higher highs. Fed rate cuts are already well underway, which means that the Fed is now in a bit of a sticky situation. They have to decide now whether they want to continue with the rate cuts, but risk escalating this rising inflation, which is a very similar mistake made in the 1970s, which led to a secondary inflation wave. Or instead, do they abandon the rate cuts, negatively impacting borrowing costs, economic growth, and unemployment further down the line? Stubborn inflation and higher rates longer term also spells disaster for the US government, who are already suffering from astronomical debt financing costs at the moment. The US government debt pile is surging at a pace never seen before and is now above $36 trillion, on pace to hit $40 trillion in early 2026. And the annual government expenditure on interest payments for this debt pile has more than doubled since 2020, now exceeding an eye-watering $1.1 trillion every year. Inflation staying sticky and potentially rising in a second wave would mean that the Fed would need to hike rates back up, increasing the yield investors demand for US Treasuries, which would of course put even more upwards pressure on this government interest expenditure. And what's even more concerning is that there is a $6.7 trillion mountain of debt that is due to be refinanced in 2025, just as bond yields are starting to climb higher again. The amount of very short-term debt issued in recent years under Treasury Secretary Janet Yellen compared to long-term debt has been very high in what was likely an attempt to time the market and refinance the debt after inflation and interest rates had come right back down. However, this strategy has turned out to be quite a poor one, as inflation has been stickier than expected and the outlook for Fed rate cuts has been dialed back significantly. To add to these woes, the share of the US Treasury market owned by price-insensitive buyers such as the Federal Reserve and foreign central banks and governments has dropped to around 50% from a share of around 75% in 2015 and is now the lowest since 1997. This means that more treasuries are being held by the likes of hedge funds or similar types of investment funds who are more willing to sell treasuries in response to changing market conditions, which potentially creates volatility and causes yields to remain higher. Surging debt financing costs is especially worrying when the US has just had its highest ever budget deficit outside of a major war or recession and is projected to remain high and keep going higher over the next several decades. And this debt situation is already setting off alarm bells amongst a number of top US CEOs and business leaders, including the CEO of Goldman Sachs, David Solomon, saying that his biggest worry for the US economy is the level of government debt. We've also seen Citadel CEO Ken Griffin writing that the surging US public debt is a growing concern that cannot be overlooked, as well as Larry Fink, the CEO of BlackRock, writing that the debt burden in the US is more urgent than I can ever remember. More leaders should pay attention to America's snowballing debt. Now, it goes without saying that a ballooning government debt pile with surging debt financing costs and also widening budget deficits is a recipe for disaster and is likely to have negative consequences on the entire economy at some point further down the line in one way or another. And this is just another indicator really that a hard landing could be on the cards and that things could get tougher in the future. And another very interesting thing that we are starting to see is a surge in super investors and corporate insiders look to reduce their equity portfolio sizes and also cash out of their stocks, which gives us a good insight on their thoughts on where stock valuations currently are. My previous video goes into more detail on this topic and you can check it out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot. Be sure to check out Moomoo as well, all the links are in the description, and thanks a lot for watching.